Last video we went through how income tax actually works in Australia, tax brackets, PAYG, deductions, all of that. But there were three things we left out on purpose because they confuse people in a completely different way: the Medicare levy, HECS or help debt, and what a tax refund actually is. If you've ever looked at your payslip and thought, hang on mate, why am I paying Medicare on top of tax? Or wondered why your take-home pay suddenly dropped once you started earning more even though you thought your HECS was sorted, then this one's for you. First up, the Medicare levy. This is where a lot of people get confused because they think it's just part of their income tax, but it's actually a separate charge altogether. The money goes towards helping fund Australia's public healthcare system. For most Australian residents, it's generally 2% of your taxable income, but here's the important bit: it doesn't apply to everyone the same way. If you're earning below a certain amount, you might not pay it at all, and if you're just above that threshold, you don't suddenly get hit with the full 2%. It phases in gradually until you reach the full rate. Those income thresholds change pretty much every year, so instead of memorizing numbers that'll be outdated in a few months, it's always best to check the current figures on the ATO website when you're doing your tax return. Now don't mix that up with the Medicare Levy Surcharge because that's a completely different thing. That's aimed at higher income earners who don't have private hospital cover. If that's you, you could end up paying an extra surcharge on top of the normal Medicare levy and your income tax. That's why you'll often hear people saying they rush to get private health insurance before the end of the financial year. It can save them from paying that extra surcharge. Now let's chat about HECS or help debt, because this has to be one of the most misunderstood things in Australia. The first thing to know is that it's not like a normal bank loan. You're not paying interest the way you would on a car loan or mortgage. Instead, the balance gets indexed once a year so it keeps up with inflation or wage growth, using whichever is lower. That change was brought in so people wouldn't get smashed by huge indexation increases like we saw when inflation spiked a few years back. The second thing people get wrong is how repayments actually work. Once you're earning above the repayment threshold, those repayments aren't optional anymore. If you've told your employer that you have a help debt on your tax file number declaration, they'll usually withhold a bit of extra tax from each pay to help cover it. Then, when you lodge your tax return, the ATO works out exactly how much your compulsory repayment should be. If you never tick that help debt box, your employer won't withhold anything extra, which might make your payslip look better during the year. But at tax time, the ATO will still calculate what you owe and you could end up with a decent tax bill all at once. So your employer isn't actually paying off your help debt for you, they're just putting money aside as you go, and the ATO sorts out the final numbers later. Another big change recently is that help repayments now work more like tax brackets. Before, crossing the repayment threshold could have a much bigger impact, but now the repayment only applies to the portion of your income above the threshold, not every dollar you earn. So getting a pay rise doesn't suddenly mean your whole income gets hit with a higher repayment rate. And you might also remember hearing about the government cutting existing help debts by 20%. That was a one-off reform that applied automatically to eligible balances, not something that happens every year, so don't expect another automatic reduction down the track. Finally, let's clear up tax refunds because there's probably no bigger misconception than this one. A tax refund isn't a bonus from the government, and it's definitely not free money. It's simply the ATO giving you back money that was already yours. Throughout the year, your employer withholds tax from each pay as an estimate. And once you lodge your tax return, the ATO works out what you actually owed. If too much was withheld, you get the difference back as a refund. If not enough was withheld, you might have to pay the difference instead. That's why chasing a massive refund isn't always the win people think it is. A huge refund often just means you gave the government an interest-free loan with your own money for the whole year. A smaller refund, or even a small tax bill, can actually mean the amount withheld from your pay was much closer to what you really owed. Neither outcome is automatically good or bad, it just shows how accurate the estimate was. So the main thing to remember, mate, is that income tax, the Medicare levy, and HECS are three completely separate things. They all affect what lands in your bank account each payday, but they each have their own rules. And if you get a tax refund, don't think of it as a bonus. It's simply your own money finding its way back to you. Between this video and the last one, you've now got a solid understanding of how your pay gets taxed in Australia. If this series finally made everything click, make sure you hit subscribe so you don't miss the next one.